Can you get the participants up? Why you go to the chat? So, good evening, everybody, and welcome to July's Residential Estates webinar. Tonight, we are going to be discussing the UK property market of 2022, a bit of a roundup and discussion of news, views, and stats, as we can see. So, thank you, everybody, for joining us this evening. I know it's still light, the sun is out, so really appreciate you taking the time to join us. If you do have to go for any reason, then no worries, because everybody will be sent the link to the replay after the event, anybody that was signed up. So without further ado, let's get started. So my name is Jason Guest. I'm the Business Development and Marketing Manager for Residential Estates. I've been with Residential Estates for about 6 or 7 years, and I've been in the property industry for about 20.
And I'm Michael Johns, Senior Investment Consultant. I've been with Residential Estates for just over 7 years, and like Jason, I've been in the industry for over 20 years.
Sorry to make myself feel a bit old.
Yeah.
There you go. And joining us this evening is Thomas Khares from Corpay. Thank you, Tom, for joining us this evening.
Yeah, thanks for having me, guys. Looking forward to it. I have been in financial services now for about 20 years, which equally makes me sound old, and have been working with residential estates for probably about coming up to 10 years, or maybe a little less. But I've been working with the guys for a number of years, so yeah, it's good to get involved.
I think you've also worked in property yourself, haven't you, Tom?
That's right. Yeah, so I worked in property for about 5 years. About 5 years ago, so I've been in the property market, so I've got a little bit of knowledge, but obviously not as much as you guys, that's for sure.
Well, thank you. I really appreciate you coming on tonight. Obviously, we're going to have a bit of a chit chat about the property market first. We're going to go through the year, how it's panned out, how we see the year progressing, and then a bit later on, Tom, I believe you're going to give us a bit of a presentation about Corpay and helping overseas clients and money, basically, in short.
Yeah, I couldn't have summed it up better.
Well, I think you probably could, to be fair. But we shall get to that shortly. A little bit of housekeeping before we get underway. We've got Abby, Rich, and Ian helping on the back end of things. So thank you very much, guys, for staying tonight and helping along with the webinar. They'll be popping in useful links, brochures, web addresses, things like that. Abby's very kindly just put our web address in the chat box as we go along, blogs, etc., downloadable PDFs. And also feel free to ask questions as we go along. We will do our best to answer everybody. If we don't get to you, then we do apologise in advance. We do have everybody's email address, so if we don't, for whatever reason, get to answer your question, you will hear from us either way. But we'll do our best to get through everybody. So we've got a fair bit to get through. So without further ado, let's crack on. So 2022, bit of a strange year. Unprecedented, I think, in the industry, certainly for the property industry. I don't think it's finished yet. We've got there a few interesting stats. So, this month began, price indices suggested that annual growth rates might be slowing down and returning to more sustainable levels. The nationwide price index for June cited year-on-year growth of 10.7%. And although still rising, it's 0.5% down from from its May figure of 11.2. I think we've got a link. A link will be going to the nationwide price index shortly, so you'll be able to download that if you want to take a bit of a look at that in full. But certainly a strange year.
Absolutely, it really wasn't what we were expecting in terms of numbers, which we will get onto in the later slides. But yeah, I mean, the popularity of property investment this year has been amazing, and we shouldn't be really surprised because it happens every year. But with the with the full effect of the pandemic being upon us now, and serious cuts having to be made, and the electric prices being adjusted, and the war in Ukraine and things, you would have thought there'd be less of an appetite for it, but it's just proved us wrong. Property proves us wrong again and again every year.
It does indeed. And I think, beginning of March 2020, I don't think any of us would have predicted the next coming, certainly that year, and then what happened after, at all. Just go back to the slides then, if we're looking at facts and figures. Halifax, even though we said we're sort of looking at a slowdown and things were predicting a slowdown, data in from the Halifax in June showed values rising again. And Halifax data showed that average prices rose by 13% in the year to June 2022, and covering more recent period than Zoopla's May index, making the higher figure more surprising. It points out that 13% is the fastest rate of appreciation that it has recorded since 2004. Again, picking on what you said, I don't think anybody would have predicted anything like that.
No, and people always say you can take stats in many different ways, and you can piece stats together. But these guys, there's the same names coming up: Savills, Knight Frank, the Halifax Bank, the Nationwide. They've all been involved in making predictions over the last 20, 30, 50 years. And they tend to be right. We criticise it every year and think, well, that's a bit steep, that's a bit ambitious. But they tend to be pretty much bang on.
Yeah. In general, Tom, just bringing you in on this, obviously it is a bit strange, certainly from the property industry. I don't think like I said, we wouldn't have predicted this back in March of 2020. How have you found things in general?
Well, in general, in terms of from a currency perspective, there's been the most amount. Well, it's been an incredibly volatile 6 months. The pound has been really weak in comparison to the dollar. The euro has been even weaker in comparison to the dollar, and we found dollar euro parity only a couple of weeks ago, I think it was now. So in terms of how that possibly relates to sort of like the property market and the investment market. What we've seen is there's been some real value for investors who are looking to invest in Europe, the UK, those parts of the world, because if you're in a country which is dollar denominated, so parts of Asia, parts of the Middle East, for example, then all of a sudden you're getting really good value by investing in this part of the world. So we've seen a real uptake for overseas investors in all different sectors, not just in property, but people who are looking to invest from overseas, who are banking, working, living in something which is pegged to the dollar. It's become a really popular time to try and invest over here.
Because we now have a do we need to go on?
Hello, everyone.
There we go. We are back, Tom. It looked like, I'll tell you what it is. It's the sun that's doing it. We had record-breaking heat wave. Then we had rain and nearly sort of winter and whatever going on. And now we've got back sunshine here. So it seems to be affecting everything, including the internet. So apologies for that. We are back. So let's get back into it. we've got here, we're talking about obviously the figures are reported by Halifax, etc. You can see there Russell Galley, who's the Halifax managing director, stated that the UK housing market defied any expectations of a slowdown. Average property prices up 1.8% in June, biggest monthly rise since early 2007. He went on to say that means house prices have now risen every month over the last year and are up by 6.8%, or just under 19,000 in terms of cash in 2022. And this is pushing the typical UK house price to another record high of just under 300,000, 294,000.
Absolutely. Well, the only saving grace here is that we've got summer months coming up where generally activity is slightly down in the industry. So anybody tracking that index should be aware that July, August are typically slower months.
Yeah.
Yeah.
Well, they are. I think we've seen it as well a little bit.
We have seen it only in the last month, though. June was very, 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 very active. Which is unusual. It normally slows down in May, but this year it slowed down in sort of early July.
Yeah.
I think as well, a lot of people are waiting till later on to book holidays. So people find it a bit longer before they're getting into that holiday mindset.
Yeah.
Which normally sort of curbs the investment a little bit. Not a lot, but just a little bit.
Yeah, absolutely. So what's, we're talking about this growth and unprecedented growth that we've seen. What's driving this growth? Now, when we actually look at it in a bit of detail, it's not initially what I would have predicted in terms of when we had the pandemic start. And I know a lot of guys, we are going to talk about COVID and the effects. Everybody's sick and tired of it. But we have been through the pandemic. So after COVID, we had reports of possible recession. We've already seen fuel prices. God, I drive a diesel. I put in £65 the other day. I think it only took it less than half in my tank.
Yeah.
So it's we are seeing the effects of that. But we're seeing we're seeing property prices go sky high. So what's driving the growth? Well, it's the old age thing of supply or lack of supply versus the increasing demand. We've got you can see there the UK unemployment figures are at an all-time low. Now we had the pandemic, and what it didn't really occur to me until I looked into it. But you got people in lockdown, families in lockdown from March 2020. Nobody could go anywhere. 1 out of 4 people were on furlough. And they were earning or they were receiving either full or 80% of their pay. They've got nothing to spend money on.
No.
They're stuck in the house. They can't go anywhere.
They're not spending money on parking and travel to work. And a lot of them, a lot of people's biggest expense is their holidays. And a lot of people booked holidays only to find out that they couldn't go, and they're getting that money back.
Yeah.
So people, the typical household has saved a bit of money there.
And then even once you had a situation where once we were allowed out of lockdown, people were then a little bit scared to go abroad anyway,
exactly,
so spend that money. So what we've now got is a situation where you've got a lot of the UK that have saved quite a lot of money. We've now come out of lockdown and people, moving around the country, they're able to get jobs or to get that other job. The other unfortunate aspect to to COVID is relationship breakups.
Yeah.
People sick and tired. Luckily, I live on my own, but I think if I lived with somebody, they probably would have had enough of me. Over 6 months sat in a flat with me. Or vice versa. So you've got a relationship splits, people moving house because of it.
Yeah.
And then we come on to builders not being able to build during the pandemic.
Yeah.
Or the world builders still building. We work with certain developers that still carried on. But the constraints of obviously the pandemic and the COVID and putting minimum amount of workers on site. You've then got problems in getting building supplies, building supplies going up in value and things like that. It all put pressure on the developers, and a lot of them weren't able to build.
Yeah.
So suddenly now we've got a lack of supply, huge demand.
Yeah.
And what does that bring? It brings sort of rates, where you've got a lack of supply and you've got a whole lot of demand. It pushes prices up.
Yeah. And a big part of that is that obviously people were still building and putting people, but not as much. But no one was buying land. ready to build new developments.
Yeah.
And it's a pipeline. It takes time to recover. And no one was thinking about, no developers were thinking about building new developments during the pandemic. They were just concentrating on focusing on what they had.
Yeah.
So now there's very few new developments actually in the pipeline. And we've struggled to source decent developments because we're very selective.
Yeah.
And so we turn back 90% of the stuff that's offered to us. But yeah, I mean, there wasn't a lot of stuff coming across our desks.
I think even now developers are wary, aren't they, about getting involved? Even now, a lot of businesses, to be fair, you're going to be wary about what you put your money into, and like I say, buying land and things like that, and doing new developments, setting up new businesses in general. You're going to be a little bit, or you're going to look into it in more depth. So, and that in itself, like I said, come back to the lack of supply and demand, pushing prices up. So yeah, that's probably one of the main reasons we're seeing this.
Yeah.
Let's move on. So we talk about the Bank of England and inflation rates, things like that. We've got the Bank of England, I'll get my teeth back in, stating that it's confident it can wrestle inflation down to a more manageable figure of 2% by 2024. And many people are saying that it is a temporary phenomenon. That situation there. Well, I suppose that's yet to be seen, but I'm sure we will find out sooner rather than later.
Yeah.
The UK. One thing to mention is we've got the UK government that for budgetary responsibility estimated that post-Brexit, the UK's new trading arrangements with the EU will reduce its GDP by approximately -4%. That's going to be a loss of approximately 100 billion per annum to the UK. And again, this could put strain on, you've got growth there, investment into the UK eventually falling slightly. And ultimately, that might have an effect on unemployment levels. However, current predictions are only showing a minor rise in unemployment. I think we've got 4.1% by the end of 2023. Even though we've got a lot of doom and gloom, I can't see it, being a major issue. It's not as bad as predicted.
No.
So, price moderation. Obviously, we were talking about doom and gloom. Are we heading for a crash? We might see a slowdown. And most people are stating that we are going to see a slowdown.
Yeah.
We would hope, or I think we need a slowdown. When price becomes too far removed from value and affordability is stretched, that's when you get a bubble.
Yeah.
And that's when bubbles burst, obviously. So, it wouldn't be a bad thing to see a slowdown at this point. And I think we're already starting to see that.
I think whatever we see in the property industry, you always see a slight slowdown or a slight increase. You don't really see these sharp spikes anymore. Particularly in the current market, we've got a lot of positives as well. I mean, I spoke to a lot of people during the slowdown during the pandemic that had a lot of cash to invest and wasn't doing anything in the banks. And they wanted to try and generate another income because there was the uncertainty about their jobs. So you've got people investing for a positive reason in a negative market as well.
Yeah.
So you always need to bear that in mind as well.
I want to move forward because we were talking about people making predictions.
Yeah.
And we've got here Knight, Frank and Savills, well-known names in the industry, well-respected names in the industry. Savills is forecasting average gains of 12.9% by 2026. Knight Frank is more optimistic at 16.9% over 5 years.
Yeah.
Now, one thing to state here, people like Knight Frank and Savills, they're not going to put their name to those predictions without a little bit of research. You don't do that.
No.
You don't put your neck on the line because it can make you look very silly making those kind of predictions. That doesn't mean to say it's guaranteed, but they've got sort of top economists working for them, etc. which would then suggest that unlike the potential predicted, like I heard people sort of suggest, are we heading for a 2008 crash? Well, no, the signs aren't showing that. And certainly property sales aren't showing that, and the supply versus lack of demand, or lack of supply and demand.
Yeah. I think they've been a bit clever here because they've both done an over 3 to 5 year prediction, and they haven't done a 12-month prediction here. Over the 12 months is probably the most likely the most uncertainty that we're going to see in the next 5 years. And we don't really want to put our heads on the block because this video, this webinar is going to go out onto YouTube. It's going to be sat there in December. If there's a massive decline, we're going to look pretty silly. But with our experience that we have in this market, we can be quite sure that there isn't going to be a severe drop-off, just on the basis of what's happened already this year. And our own figures that you'll see in a moment will prove that.
Yeah, I think, ultimately you're going to see things like inflation settle down globally. As generally, COVID, a lot of countries now are out of lockdown.
Yeah.
We're seeing movement, we're seeing free movement globally again. The only slight caveat to that, and I think we mentioned it before, is the war in Ukraine.
Yeah.
Not going to get political. We're not talking about that in terms of what's right, what's wrong. But it is obviously constraining gas, oil supplies, grain supplies, things like that. That is obviously going to have an immediate effect. But then, as we saw previously, the Bank of England is confident it can reduce inflation to a manageable 2% by 2024, which obviously is then going to have a positive effect on UK trade overall. So, how's it fared in terms of us? I mean, I think we've been talking about obviously the UK market. I think it directly correlates. You can see that certainly. Well, from these figures, this shows a 5-year figures of what we've done in terms of investment sales from 2018. Obviously, there was a slight downturn in 2019, but then the past 3 years, we've just sold 2020 332 units, 341 in last year. And this year, we're already at 284, and obviously projections suggest that we're going to easily beat records this year. Like I said, unprecedented.
Yeah, I mean, these figures are quite surprising for a few reasons. I mean, the average buy-to-let yields are down because salaries haven't increased, but so rents haven't increased, but the prices have gone up. So there's less in it for buy-to-let investors than there was 5 years ago. I remember selling Manchester and Birmingham 5-6 years ago, and they were getting a standard net yield of 6 to 7%. They're only seeing 3 to 4 to maybe 5% now in those growth areas, and that's for an off-plan purchase. A lot of our opportunities at the moment, one thing that we have noticed this year, there's more re-engineered buildings. There's more commercial to residential conversions. A few reasons for that. One is that developers can get, quite straightforward planning permission on them because they are what's called permitted developments, PDs. But also the amount of office space that's now available in good areas, of a good build quality and maybe only 10, 20 years old, the building. And he's being rezoned now for residential, and there's a lot of them on the market, and people are picking them up cheap. I mean, you wouldn't invest in commercial property at the moment for sure, because there's so much uncertainty with more people working from home. So that's another area. I mean, student property. We were selling student property 5 years ago with 10% net returns. Now the norm is around 8%. However, like we were discussing before, there are some opportunities on completed properties that we found. And we are seeing a big shift now for people wanting completed properties so that they can plug in that return directly into their lifestyles. So people are desperate to try and secure another revenue stream, because maybe because of uncertainty in their own jobs, So this is something else we've found this year. But one area that we've really focused on is looking at smaller developments. We've noticed that a lot of the bigger developments are more likely to see delays.
Yeah.
They generally take longer to build. And also there can be problems with some of the larger developments with gaining finance, because lenders don't really want to lend on a large number of apartments that are all hitting the rental market all from the word go. But our focus on short-term let property has really brought us to the forefront in the UK investment market, because we actually manage a lot of the properties ourselves, and we've got a history of delivering yields of over 10, over 12, sometimes over 15% net yields fully managed. And that is something that I haven't seen in the market in 20 years of being in the market. So, and to this sort of level. So now a lot of our investors are waiting for that next opportunity. And a lot of developments that we've sold this year, of developments of 15, 20 units, have sold out in 1 to 3 days. People have not been quick enough to get in on them. So it's been a real, adventure for us this year already, and we don't see that changing. We've got new developments coming online in the next, few months that we'll expect to sell them out within a few days. I don't see that changing. I've already got people, waiting for the next development roles. So,
and you mentioned figures there of sort of 8, 9, 10, 12, 15%. And I know we were talking earlier about yields, and sometimes people, you tell them that, and they think you're talking rubbish or whatever, but it's there, isn't it?
We've got these in some resale properties where the actual tenants are in place. So we've got some students and some smaller residential units that are quite cheap, and they're delivering sort of 8 to 10% with a tenants in place. The short-term let properties are a little bit different, but because they're so popular and nobody ever wants to sell them.
Yeah.
But yeah, we've got some great opportunities in place, and for anybody looking to plug something into their portfolio at the moment should really be on the phone to us.
Yeah. Right. Well, we've spoken a little bit about the sales market in the UK and about residential estates, how we found the year. Like I said, it has been a very strange year, unpredictable, and set to continue. Let's take a look at the rental market. I mean, ultimately, if you're looking at investment property, you're looking to purchase an investment property, then unless you are buying to flip, then you are reliant on the rental market, be it long or short term, and the occupancy rates, and obviously the rent levels and everything that you expect with that. So let's have a quick look into the rental market this year. You mentioned about property prices gone up. Returns are still low because the property prices have gone up.
Yeah.
But you mentioned that rental figures are also going up, and that they are. I mean, if we look, the June lettings index from HomeLet found that average monthly returns rose by an average of 10.6% year on year. I'm hoping that you'll get in chat there. We'll get you a link to that report that you can download and take a look at that. But it isn't an isolated figure. The rental platform Rented reported that average UK rents have risen 9.8% since the start of 2020. And the most recent UK rental report from HomeTrack indicates annual growth of 9.1%. So why are we seeing these rent levels?
Well, the financial environment it dictates that these aren't figures that we should be seeing. We should be seeing the rental values coming down or staying as they are. But what can you do when you've got such a shortage of supply?
Yeah.
Surely those landlords are going to see that there's nothing else available in the market, and they're going to increase rents. Of course they are.
Yeah.
So it's it's purely driven supply demand.
And you've got a very loud voice, John, and I don't want my landlord hearing this because he hasn't put my rent up in a couple of years. But keeping my fingers crossed he isn't watching this either. But also, you know, in the rental market, it is very similar to the sales market. Again, it's that lack of supply versus demand.
Yeah.
It's no different to the sales market. You've got people moving now. As we said before, in COVID, you've got relationship splits.
Yeah.
You've got people then perhaps not being able to buy a house straight away. They want to move out, so they're going to go and rent. We talked about movement around the UK, and that's where your short-term lets come in.
Yeah.
You've got a new job down the bottom end of the country. You might go and stay in a short-term let but until you get yourself sorted, you know, and things like that. So the rental market, as we all know, it's always spoken about, but it's very, very strong. It's not going anywhere.
Yeah.
It's always required. There's always somebody that wants to rent. And I think we've got some figures shortly that just, I suppose, prove that even in the pandemic, there's still a market. It doesn't matter what, I suppose, the state of play is.
Yeah.
It could be in a global pandemic, and we'll get on shortly to the figures showing some short-term lets. But there's always a market, I suppose, is the message.
Yeah. Absolutely.
So, just popping in, we mentioned that, Savills as well mentioned that the 5-year rental forecast estimates that average rents will rise by 19.9% by 2026. Again, that's an annual growth of 4%.
Yeah. Well, there's so much disparity at the moment between the sales prices and the rental prices, and there has been for so long. People just didn't want to put pressure on households if they've got a tenant in place during the pandemic. They don't want to rock the boat and lose their tenant and then be able to not be able to fill it. So people are really clinging on to what they had as opposed to rocking the boat. So
yeah, no, absolutely. Well, we've mentioned short-term lets. It is a market sector that we're very knowledgeable in. And certainly it's come to the fore in the past couple of years, hasn't it? In terms of an investment option, so to speak. So let's just take a look at the figures from Visit Britain here. Now these are going back to 2019. Obviously, this includes hotels, B&Bs, and short-term lets. But if we just take a very brief look, and you can see standard year in 2019, you've got occupancy levels there of between 65% in January, and then going up as you'd expect throughout the year. That's a fairly typical standard year. You get the summer months, and as you get into December, things tail off slightly, but it's fairly standard throughout the year. We can then see in March of 2020, when that hit, we're down at 37%, then 22%, and you're in the 20s then while through lockdown, and then things get back to normal again. We see, come out of lockdown, and back in 2022 now, we're seeing things sort of start to get back to a normal level again.
Well, what you need to see, Jason, as people may look and get really scared at these figures and think 22%, 23%. At that time, I mean, these figures include hotels, bed and breakfast, and short-term lets. They were all short-term lets, all of them, because all the hotels were closed, all of them. All the B&Bs were told to close. So in certain areas of here where you've got very low figures, the hotels weren't open, and all of that would have been short-term lets.
Yeah, absolutely. Well, I mean, this is probably a good time just to move straight on to correlate that and what we found. And these are our occupancy levels and ADR, which is average daily rate, or the nightly rate that you're going to be charging people. And I suppose this isn't so. It is a little bit shouting about what we can do, because but it also, in a way, correlates, but also shows that even in a pandemic, there is as we've said, there is a market. So we've got this is a development called City Suites in Chester. We sold it as an investment development. Investors purchased this, and then for the past couple of years, it's been rented out, the majority on short-term lets. We can see there in terms of 2019, we're up at 73% occupancy levels, £78 a night average daily rate. Then if we skip straight to 2020, Q2 of 2020, the pandemic hit. Now we're above the average there from Visit Britain. We're at 35%, and going on throughout the year into Q3, we're actually at 43%. So not that far below 50%. We managed to hit the key workers, people staying in Chester. Still, we're in a global pandemic. People still need to live somewhere.
Yeah.
There are still jobs that require accommodation, and that just proves that. And then, then go through the years, we come out of the pandemic, and then back in now 2022 this year, Q1 and Q2, you can see the occupancy levels increasing again, and so are the ADRs. So that's nice to see. But again, it just hits home the fact that there is always a market. The market in the UK is very strong, and always required.
Absolutely.
So I think we have got a link to our short-term Let's brochure going into the chat. Hopefully, people can get a bit of info on that. So we've spoken obviously about the UK-wide figures, etc. Ultimately, property has got an excellent track record, as we can see, producing good rental income, strong long-term capital gains. House prices since 1995 have outperformed inflation by 3.8% per annum. So, Johnsy.
Yeah, well, I suppose what people are going to want to know from this, most of the people who have joined us today are investors. They're going to want to know, well, is it a good time to invest in investment property at the moment? Is there a bad time to invest? Well, what I would say is that regardless of the market, the most important timing issue is your time. Is it the right time for you to invest? Because that's more important than the market, because the market will go a little bit like this at times. But the most important is whether it's the right timing for you. And the way the media portray the market, that will have some impact on prices and rentals and things, but it's minimal, and it's more important for an investor to invest at the right time. And on the flip side, don't be drawn into a purchase just because of how it looks when it's the wrong time for you to invest.
And I think the thing on that, what we're trying to say is we've shown a lot of figures. We've shown property prices increasing. We're possibly showing a slight slowdown, but no crash, and things like that. But still, to the answer of is now the right time, you can't answer that in terms of is now. Well, it's whether you are. Is it the right time for you?
Well, it's a much better time than it was at the start of the pandemic, because at the start of the pandemic, we didn't know how severe it was really going to hit our country. We didn't even know whether we'd still be in lockdown now or be going back down into multiple lockdowns. At least we're through that now, and we're looking back and looking at the government repairing the damage that had to be done to the amount of money that was spent over lockdown. But I mean, I spoke to a lot of people. As I say, I spoke to airline pilots who were cash rich, but had money in the bank, but were unsure about their jobs and wanted to create an additional revenue stream. So even in the worst possible times to buy, people will make their investments based on their own personal circumstances. And generally speaking, if they're buying in the right area and they're buying the right location, the right product, the right property, they will do well. And it really depends on their personal circumstance. And that's what we're here for as consultants. We're here to address your personal circumstances and try to match you up with a product which is going to suit you. And believe me, I've sat in that office there, and I've heard our sales guys, so-called sales guys, put people off buying a property because it's not right for them. And we will do that because, remember, a lot of the properties that we sell, we also manage. So we don't want to cause problems for people. We want people in a long-term relationship.
I think that comes on to your next question of, is there a bad time to buy investment property?
Yeah,
well, if as experts we identify it's not the right time for you, then that's a bad time to buy investment property.
Absolutely. And it is, you will not have us rush you into anything. You know, if there's a brand new property development and it sells within a few days, yeah, we may tell you that, you know, in order to be involved in it, you're going to have to put your money down quick. But if it's not right for you, we will totally understand that. But you know, we've seen a different landscape of how people are buying investment property this year. With smaller developments, have to move quicker, but we're educating people through these webinars, through the blogs, through the YouTube videos that we have, and educating people into short-term let property. I mean, we were talking before, weren't we, about usage of short-term let property. Some people come to me and say, oh, I don't want to buy a short-term let property. They'll be wrecked in no time. You know,
yeah. How many times do we hear that?
Yeah.
Over a 5-year period, it's a fact that if you have a long-term letting, then and you also have a short-term let property that you then let for 5 years, you will find that the actual wear and tear on that long-term property will be a lot more than the short-term let property.
Yeah.
Why is that? Because it's cleaned every single time a tenant comes in and out.
Yeah.
They're cleaned up to a very professional standard.
Yeah.
And they have to be, because short-term lets rely on reviews from tenants. If you want the short-term let to work, then on places like Airbnb, Booking.com, even our own sites, people will go and they will book the properties that have got the best reviews.
Yeah.
And not only that, and we'll get on to the ones that stand out and things like that. But in terms of reviews, you know, the only way you're going to get good reviews is if you provide a home from home and a quality piece of accommodation for that every single tenant that goes in.
Yeah.
Therefore, you know, every time one goes in, you get the cleaners in and it's put back to near perfect condition.
Yeah.
Every single time. Is that done with a long-term family in 5 years of staying in the same property?
Well, what's the first thing they do when a family goes into an apartment or a property? The first thing they do is put shelves up, put pictures up on the walls. You know, your walls are destroyed within a matter of minutes.
Yeah, yeah.
You know, a lot of these short-term let properties, particularly from our corporate market, they don't even go in the living areas. You know, they'll come back late from night, they'll go for a meal after work with colleagues, and then they'll watch Netflix in bed on their iPad for a few hours and fall asleep. They're up at 6, 7 o'clock in the morning, shower, change, out, and that's it. The property's empty for most of the day.
Yeah.
So yeah, if you look at the properties that we've had on our books for the last 20 years, or let's say the last 10 years, look at an apartment that's 10 years old that's been rented out on a standard AST, and one that's rented out on a short-term let basis, there's a remarkable difference between the two. And the short-term let property will look immaculate all the time. They have to.
You've also, I mean, you mentioned about staying in the property. That also relates to leisure stays as well, because obviously you mentioned corporate stays, and we get a lot of corporate bookings, employees moving around the country. But your leisure stays, so people booking tourist spots like your Anglesey, North Wales, Lake District, Peak District, places like that, they've not booked there to stay in the apartment.
No.
Okay, they want a nice apartment to stay in, but they've generally not gone there to sit for 2, 3, 5, 7 days, 10 days in an apartment.
Yeah.
They've gone there to view the place that they've gone to visit.
Yeah.
So again, they're going to be out of the property for the majority of the time.
Yeah.
Therefore, reducing the wear and tear. So yeah.
So we were saying, if buying now, what would be the best property to buy? Well, it's obvious what we're going to say. You know, short-term let property. You know, the returns that are available for it on a rental. From the rental side, far outweigh any other property investment out there, including HMOs, including all of these fandangled schemes that we're seeing now, including leasing property, which has got no long-term benefits whatsoever, but also the growth that we're getting or experiencing now in the price of these properties. They're being resold to investors who are quite happy to see a 7, 8, 9% return. We've got history showing it's got a 12% return over the last 3, 4 years. You know, it's an easy sell. It's an easy sell, and what you can do is increase the price in order to reduce the yield down slightly, and it's still at an acceptable level.
Right.
So short-term let property, if you're looking at buying somewhere at the moment and you don't know about short-term let property, ask one of our consultants to explain it to you. We've got loads of material on the subject. We can prove to you, we can physically prove these returns to you. You know, so get on the phone to us. Do not go in and buy a standard buy-to-let at the moment, because, you know, particularly if you're looking for a high rental yield, you need to be in a short-term let, and something that is managed by a reputable company like ourselves, who've been doing it for over 15 years.
Yeah, absolutely. I just noticed Tatiana asked a few, and apologies, Tatiana, because I've only just noticed in the chat asking a few questions there. And what we can do is certainly send you some information regarding short-term lets and long-term lets for Tatiana to have a read.
Yeah.
We've got some exact examples, of both. And we can also send figures of city suites and actually how they've been working for the past year. And then you can see direct correlation between long-term lets and short-term lets.
Absolutely, yeah.
Also, we were just talking there about long-term lets and short-term lets. One thing to mention is that if we're sourcing a short-term let development, we will do our due diligence and ensure that it works for both.
Yeah.
Whereas you can't do the same the other way round. Now, I'm not saying there's anything wrong with just standard long-term lets.
No.
But you'll find with short-term lets that in the right development, that if for whatever reason the short-term let market dried up, then it will work for long-term lets as well.
It's the flexibility of having it in multiple rental options.
Yeah, it's having that, like you say, multiple rental options is the key, certainly with it. So, where are the latest hotspots?
Well, any of you that know me out there will ridicule this question, because ask yourself the question: if I tell you a hotspot is a particular city now, and then next month I tell you it's somewhere else, what's happened to that hotspot? Is it no longer a hotspot? People will choose cities, and these are what we call markets. You know, Manchester, Birmingham. What we need to do is look at the micro markets. We need to look at, an area within a city which has got good corporate coverage or good tourist value, good transport links, whatever it might be, something that's going to attract people to that area. That's really important, because a lot of people are saying, well, I'll go out and buy in Liverpool. And, in Liverpool, over the last few years, 3 of the top developers have gone bust. It's a beautiful city, but it's a very challenging city at the moment and very saturated with property. But still, you've got people writing about it in the media in London, saying it's the place to buy. And generally, those articles are being written by developers.
And not only that, just to jump in there, if you're reading an article, if you are sitting there reading an article on the internet or on the paper about a hotspot, you are too late.
Yeah. We almost avoid hotspots now, because we'll try and find somewhere where other people aren't. What you'll find is you'll find a great hotspot. Typical example of this was Coventry about 6 years ago. Coventry was identified as having a real shortage in residential and student property. Somebody went in and started building there, followed by another 25 developers who bought up loads of land and developed the place to death. And then all of a sudden it's not appearing on any lists. It's no longer a hotspot. And a lot of people are buying off plan as well. So they've got 2 years to wait for the property. By the time they get it, it's saturated. So what we try to do is go about our business quietly, do our own due diligence, find a niche area within a city where we know we have maybe corporate relationships in that area with big corporate customers, places where we know that there's a touristic demand, and try actually in some cases to look at areas where there's planning restrictions. Places like the Lake District, places like Rossniger in Anglesey, where there's planning restrictions. We love them, because we know that we're going to develop there, we're going to, maybe convert a building into apartments, and there's going to be nothing else on the market. We know
there can't be.
There can't be, yeah. So, Doesn't always work, but generally speaking, the concept is right. That's what you need to do, and that will bring down your risks. Now, just finally, because I know we're cutting into time a little bit, some ways of reducing your risk.
Yeah.
Having that flexibility in your rental models will reduce your financial risk. It will give you more markets to go at for your rental property. Always look for a good profile of tenant. That's one of my big favourite ones, because at the moment we've still got a lot of people selling cheap, nasty houses in cheap, nasty areas with a terrible profile. And people think they're clever because they're buying a 3-bed detached for £30,000. Well, I'm sorry, it's still going to be worth £30,000 in 5 years' time, because no one wants to live there. And you've got to think about these things and the quality of tenant. Is that tenant still going to be paying you? The tenant's unemployed. Is that tenant still going to be paying you in 5 years' time? And people, this is, all the problem property programs that you see on the telly are all about this sector. So we go into a completely different tech sector. Let's look at good quality tenants, good quality areas, and reduce the risk, because it's just as important for us as it is our investors.
We manage properties as well.
We're managing them, yeah. So and the other thing is with short-term let property, one of the biggest things that we've found is that they have to pay up front before they get allowed into the property, and they don't have tenant rights. They're there under license like they are in a hotel. If they don't leave the room, you can get the police to come and chuck them out. You can't do that with a standard tenant, a long-term tenant.
Well, funny enough, I worked in lettings for 15 years, and about probably 5 of the worst tenants I can remember in history were all professional people. They passed referencing. One of them was a lawyer on over £100,000.
Yeah.
Didn't pay his rent, trashed the place. Absolutely terrible tenant.
Yeah.
So just because you might look and go, oh, there's a reference, it's great, he's a great looking person, he's a professional, or I don't want those housing benefit, but just because somebody doesn't have the benefit doesn't make them a bad person.
No.
But you can get bad tenants in any walk of life, I suppose is the point.
It's more the area, the focus, not the person. So if you're in a good area, people are paying more money, and therefore you are going to attract better. On average, not always.
I was going to say, don't get me started on some horror stories.
I know, you always kill me off with that, aren't you?
But I think also, we're talking about how to maximise your returns. I think that question could be answered. We could go on, we could have a separate webinar on that in itself.
Yeah.
One little tip we were talking about earlier on short-term lets is to don't skim on fixtures and fittings.
Yeah. Exactly.
Well, on short-term lets, one of the main things is when people book, you may have done it yourself, if you've booked an Airbnb or a booking.com property and you're looking and you've got very similar properties, you're going to go for the one that stands out.
Yeah.
The one that sticks out to you and goes, oh, that one's better than that. I like the pictures in that one. I like the look of the furniture. You mentioned a story about a picture somebody had taken.
Yeah, no, so one guy who's bought up, I don't know what they might be on the webinar. But somebody recently bought, so he used to be a cartoonist for a newspaper. Okay. I said immediately, get some cartoons in frames,
a bit personal,
and personalise your apartment, because that will go a long way. And actually, I was telling you about the picture before. People have taken that as part of doing reviews. Sometimes people post the pictures to TripAdvisor, and actually there was one picture in one apartment that about 3 or 4 people had just taken a photograph just of that picture. Yeah. So obviously they liked it, and it's something that they will remember and be able to relate to that apartment. And when they return to that location, they will try and book the same apartment again.
Yeah. It's funny you mentioned that. It's tiny little things. One of the apartments I know that we manage in Ross Niger, obviously you're near the sea.
Yeah.
They've got a boat.
A boat, yeah.
They've got a model boat on there, and it's a small little thing.
Yeah.
That probably wouldn't have cost a huge amount to put that in there, but it just adds to the aesthetic.
It does.
And it helps with bookings. I just want to grab. I noticed Adil. Thank you, Adil Bagir. Has asked if I can achieve 8% net yields for AST, why should I go for STL, especially if the purchase price for STL area is higher?
Well, Yeah, firstly, I'd question where you're getting 8% net yields from it for an AST. I think most of what I've seen available on the market recently, that would be in a poorer area.
Okay.
Because generally in the housing market in the UK, if this is the average here, you go one way and it's a nice area, an affluent area, and therefore the prices are higher, therefore rental returns are lower, because rental returns don't follow pricing. Go the other way, you've got lower prices, therefore a higher net yield. But what you've got is problem tenants. But if you are naturally getting a 10% net yield, uh, uh, you're going to do pretty badly if you're only getting 8% net from a short-term let property in a good area, because most of the properties that we do, I mean, we forecast year one pretty much always over 10%, and that's really taking a 65% occupancy where we know we're going to achieve around 80. And a lot of the time we'll even reduce the nightly rate, and if it's £100 a night, we'll put it as 80, because we like to under promise and over deliver. So really, I mean, Adil's just posted that he's in Sheffield. Now, Sheffield is a market which again has seen a lot of problems recently, and I'm not going to go into it too much, but there's 110,000 properties actually in the university in Sheffield, and they're still building student properties, and they're having to convert some of the smaller student properties that are just built in Chinatown into residential properties. So I suppose it's an area that we kind of avoided. And I'd be interested, Adil, to see you achieving that over a long period of time at 8%. If you're getting 8% in Sheffield on ASTs, then good on you, and send me the link, because I'd like to buy some myself, actually.
But then we come back to, we've just spoken about long-term tenants again, and if you've got the money and you've got the chance of either buying your 8% property, which is going to get capital appreciation and all that, and you might get a long-term tenant, and that's great. That's a great yield for an AST. But if you were then offered, you could then buy a property that was giving you 10 to 12%, and it is going to be in better condition in 5 years' time. Then why would you not consider that? I suppose. There's nothing. I suppose the idea what we're saying is, if you can get that 8%, there's nothing wrong in that. We just feel that there's probably better deals or better ways of making money or more money on from your own money than that.
Absolutely, and look, we're not always right, but we have probably over 400 investors. We have over 400 investors who currently own investment property offers and short-term let property who are achieving over 14%. So historically, so I mean that is a huge.
What was the one in down south in
Bournemouth?
That was 15.
That was 15 plus. So that was nearly 16%.
And that's actually, a studio apartment.
We've got a testimonial from that lady that's on our YouTube channel. That speaks to Paul. That spoke to Paul. She bought it as it was being refurbed, or towards the end of it being refurbed, and secured it straight away. She got tenants in, and she had tenants in there all the time. This isn't your standard Airbnb stock we're talking about here. This is stuff that we have spent a huge amount of time and effort sourcing. Both Mike Holiday and Paul Winder travel around the country and get the best deals for us in the best areas. We use facts for our due diligence, which no other agent does in the UK, as far as we know.
That's for anybody just thinking that's not facts as in facts. It's the company Fact, FACT. Normally, they've been around for years. I saw them on Movie Piracy, and they do a lot with the government and things like that. But they also do a lot of due diligence reports, and we use them for developers.
We do, and we go over and above, really, because it's not only important for our reputation, Adil. It's also important for us, for us when we're actually managing the property. We don't want something that's going to bring our our average daily rate down and our occupancy rate, because we're very proud of what we achieve already.
I believe, and I might be wrong, I think my colleague James is dealing with yourself, but we'll certainly get some more information about short-term lets. I'm sure James has already sent you some, but we'll get in that link to that testimonial with Bournemouth.
Yes.
And we can get the figures for City Suites in Chester as well for you to have a look at.
We've got a couple more questions.
Jendra Shah has mentioned there's a new regulation announcement by the government to regulate short-term lets like planning and restriction to let for 90 days. What is the panel's views? I actually don't think regulation is a bad thing.
Well, actually, it only applies to London at this time anyway. Marie's very correct in what she said.
But I don't. If they rolled it out elsewhere, I don't think it's a bad thing at all.
But what they will always try and do in this area is try and regulate. So, and the people that will lose are the people, the mavericks, who are just they're ad hoc managing their apartments part-time, and they can't do it professionally. What they want is professional companies like us to take more properties on and professionally manage them. But when you've got people, I mean, I've stayed in Airbnbs in cities that have been totally run down. The picture beautiful, and when you get there, the television's off the wall. And we stay in those apartments when we go to London doing shows. Yeah. We've stayed in a few that have been an absolute
last time we were there, I think Phil maybe got bitten.
Yeah. So, look, I mean, they want people to professionally manage apartments. Whatever system they put in place, we will have a way to manage it within those parameters. So yeah, we welcome more legislation in this area, because there was an article saying that there was an estimate that 95% of lease properties on Airbnb are on there illegally, because the lease doesn't allow for them to let on a short-term let basis. And quite right, there's people doing it all over the country.
And suddenly now that negates your insurance.
Yeah.
You have a problem with the tenant, they hurt themselves. You have a problem, they burn the place down, they leave a cooker on. Suddenly now you've got no insurance.
And your buy-to-let mortgage, the moment the buy-to-let mortgage provider finds out that you're going against the terms of the mortgage, they can ask you to pay your mortgage back in 30 days.
Yeah.
So there you go. Are there any more questions, or are we going to?
We've been talking a lot, and Tom's been sat there very patiently while we rabbit on. Plus, Johnsy here has got a very loud voice, so my right ear is needs.
It's only soundproofing.
I just want to leave you with the fact that, according to Nationwide, a typical UK residential property grew in value from £11,000 in 1975 to £271,000 by the end of 2021. That is approximately a 2,300% increase over 46 years. And although that doesn't quite match up to the old maxim that property doubles every 10 years, sure, that's impressive.
It is impressive. And I mean, I'm not as old as you, Jason, but but you probably remember those times. But I certainly remember my mum and dad buying their three-bed semi in a decent area of Cheshire for £18,000. So it's I can quite believe it, and that was in the sort of early 80s.
Oh, absolutely. I think gone are the days now. You can even get properties in auction for low prices.
You can.
But so that's the UK property market. We've rabbited on. If anybody wants to book a consultation, please feel free. The links will be in the chat. Really appreciate you obviously sitting through that. If anybody has got any further questions, we've got our website and the email address that will be coming up later. Feel free to pop us an email. But we've done a lot of talking, and I'm now going to hand you over to Tom Khares from Corpay. Thank you, Tom, for your time. Really appreciate you sitting through that, and we will let you free.
No worries, guys. Thanks for that. That was very interesting. As I sort of mentioned at the start, I'd worked in property a number of years ago and found that really interesting and informative. So thanks for that. Obviously, been working with residential estates for a number of years. Have a really good relationship with the guys. So really happy to be involved this evening.
Tom, can I just check? Sorry, is your mic on?
Can you hear me now?
Oh,
There we go.
there we go. There we go. You're with us. Back in the room.
Start again.
Start again.
Yes.
The basic technical failed straight away.
Oh, it's been an evening. It's been an evening. But anyway, apologies. So thank you, Tom.
No worries. Yeah. So, yeah, as I was saying, been working with residential estates for a number of years, and it's great to be involved this evening. It was obviously really interesting to hear what you guys had to say, and hopefully I can link in what we're doing at Corpay with something which will be of relevance and use to the people who are on the webinar. So Corpay, who is Corpay? Who are Corpay? Corpay are a global payments company. So what that means is we're an S&P 500 company. So we're part of FleetCor, which is a global payments leader. And our client base is typically twofold. It's either corporates. So corporates you guys may have heard of will include the WTA, the Women's Tennis Association. We work with Yamaha. We work with Tesla in the UK. So we work with some high-profile companies. We also work on the personal side of things as well. So where we've got clients in the investment sector and particularly in the property sector, we're able to provide payment solutions for anybody who's got any sort of international exposure. Now, in terms of our reach, just to give you a little bit of an overview, I think we can work with up to, I think it's 145 currencies, and we've sent money to over 200 countries. So if there are any of you on the webinar this evening who are based further afield, the likelihood is that we've dealt with somebody from your part of the world before, we've dealt with your currency before, so it's certainly something that we can look at, and so it's certainly something that we can help you out with. Now, just in terms of what's been going on, so just want to give a really brief overview of what's been going on in the in the foreign exchange market and the currency market, and then try and link that into what our services are. So if you see the news, big volatility in the markets recently. The dollar has been strong, and that's probably been a reflection of the fact that there's been geopolitical unrest. So wherever there's, basically, without being too crass, whenever there's a war, people tend to take sort of solace and security in the dollar. So as the guys mentioned previously, there's been war in Ukraine as well as in other parts of the world, and that has all lent to a strong dollar. Which is the real headline on that has been that there's been dollar-euro parity, which was achieved a couple of weeks ago. So for anybody who is in the US, obviously, or any other part of the world which is dollar denominated, so the Middle East is a big one. So anybody in Dubai, Abu Dhabi, the UAE, Qatar, different parts of Asia, different parts of Africa whose currency is pegged to the dollar, then it's been a really sort of appealing time to invest in Europe and in the UK. So we've seen real strength of the dollar. Now that may change because for anybody who's interested, there is going to be an announcement tomorrow from the US Fed, and the guys mentioned interest rate hikes in the UK. That could be mirrored in the States tomorrow. So the impact of that may well be that the dollar will weaken in relation to the pound and the euro. So for any of you who are in, again, as I mentioned, dollar-denominated currencies, you may see that the really favourable rates that have been in place over the last sort of 6 months may change. It may move back to where it had been. So for anybody who is looking to invest from overseas or to buy from overseas, it's really important that you're in a position to act and to move quickly on that. In the UK as well. So over here we've got a new Prime Minister inbound in the next sort of 6 weeks. Maybe we'll have a new Prime Minister. I'm not sure if the guys or if anybody watched the debate last night. So we'll see what happens there.
No, I didn't. Did you watch are you into politics?
No, not really. Not really. I try and stay away from it, to be honest.
It's very wise. Time, though. It's certainly an interesting time.
It is an interesting time, and just a couple of sound bites on that for anybody who's interested. If the theory is that if Liz Truss becomes the new Prime Minister, then it will actually have negative impacts on the pound. So any sort of lowering of taxes and potentially triggering Article 16 in relation to Brexit will see the pound weaken further. So there's two sides to the coin. If you are investing from overseas, so in the countries or the parts of the world that we just mentioned, then it's something to look out for because, again, you'll be getting more value from investing in UK property, for example, because of that weakening of the pound. So it's an opportunity to take advantage of that. So these are things to be aware of and things to look out for. Just the final thing that I really wanted to go through today was just in terms of how our services can be of benefit and relate to people on this call. So let's say, for example, or just give you an example of how people would typically look to move money from overseas. And again, this could be personal, it could be corporate, it could be in a number of different guises. Now, what a lot of people will be familiar with is what's known as spot trading. Now, that's fairly self-explanatory in the sense that it's based on a price on the spot, if you would. So if you're sending money from the UK to Europe, vice versa, from different parts of the world, across borders, then you'll be quoted what's known as a price, and that'll just be on the spot, so the rate at that particular time. So a simple example would be you're going on holiday, you're looking to buy some drinks at a restaurant. This is what the euro to pound conversion is. So I would say that 9 out of 10 people, particularly personal clients who are investing for themselves, would use this sort of trading. Ultimately, it is taking a chance on what the rate is on that particular day. It could be in your favor, it could not. It's just taking a chance on what that rate is, and that's not for any reason other than possibly just a lack of awareness of what other products are available to you. So it's not necessarily doing anything wrong. It's just that's just what's known and what's available to you. So what we can look at doing for clients is what's known, well, two options really. Number one is what's called a forward contract. Now, a forward contract basically fixes an exchange rate for a period of time. So it could be a specific date. That could be a month into the future. It could be up to sort of 3 years into the future. So let's say, for example, you're buying a property. You had a deposit to pay for the property, or you're paying in cash, either or. And you knew that property was due to complete, let's say, in 6 months' time. So you needed to go, let's just say, dollars to pounds in 6 months' time. Via traditional methods, you would be exposed to what the exchange rate is. So you'd be spot trading. So what the rate is on that day in 6 months' time, you transfer the money over. That's what rate you get. That's how many pounds you get. What a forward allows you to do is lock in a rate. So over that specific time, you would take out a forward contract that locks in the rate so that you know that in 6 months' time, when you need to draw that money down, the exact amount of money that's going to cost you in effect. So you're taking away any exposure to foreign exchange fluctuations. So if the markets move against you, for example, then you fix the rate, and it's a really good piece of planning, shall we say. So you know exactly where you sit 6 months down the line, 3 months down the line, depending on the period of time. So real benefits in that is, like I say, sort of security, confidence, and comfort that you know exactly how much money you're going to move in that period of time. The downside of a forward is that if the market moves in your favor, then you've not benefited for the market moving in your favor because you fixed a rate in advance. So it could be that the market moves in your favor, and you could look at it and say to yourself, "Oh, if I'd just done a spot trade, then I would have actually been better off." So that's a negative of forward. Now, that's where the final product that I wanted to mention to you, final solution, what's called a forward extra, comes in. And this is something which is fairly unique to Corpay. As I mentioned, Corpay is, an S&P 500 company, Fortune 1000. We're able to offer some really unique products. And what a forward extra enables you to do is all the benefits of a forward. So you're fixing the rate, you can lock it in for 6 months' time. You've got a property that you're looking to purchase at a period at a later date, for example. You lock in the rate, so you've got that benefit that you know that if the market moves against you, you're still in a strong position. The difference and the benefit of a forward extra is you build in what's known as a rebate feature. And what that means is if the market moves in your favor to a certain point, then the contract will rebate the difference. So let's say, for example, pound to dollars comparably weak. Let's say, for example, the Fed, you take out a forward extra contract. Let's say the Fed interest rate hikes interest rates. Let's say that, without saying that any favoritism, let's say that Rishi Sunak becomes prime minister and the pound strengthens. Then, if you're taking that forward, you may not have benefited from those two key events, which would strengthen the pound. The benefit of a forward extra is that it gives you that rebate feature, which it would enable you to benefit from any strengthening of the pound in that situation, and obviously vice versa as well. So there are a couple of products that we can look at for investors. So for any clients who are looking to invest from overseas. Similarly, if any of you are based in the UK and are investing overseas, or have any exposure where you're making payments overseas from a corporate perspective or just from a personal perspective, then that's something that we can certainly assist you with. So just while I get a quick sip of water because it's really hot in my apartment. Have you guys got any questions for me at all?
I don't think you work with quite a few overseas investors, don't you?
Yeah, I mean, look, anybody who's looking at exchanging currencies, go to Tom. I've worked with Tom for a number of years. Corpay are obviously a big company, but a lot of the people who buy into us and who buy into investment property, they also buy into people, and they need people that can trust. And Tom is a great guy, and he'll look after our customers. So, I would certainly recommend him to any of our buyers from overseas that need to make the most out of currency change.
Yeah, absolutely.
Cheers for that, Johnsy. Thanks. I think that's very kind of you.
No problem, Tom.
Yeah, I mean, what I would say is that the currency market, for anybody who wants any more detailed information on that, and you may have other investments or other exposures, the currency market is the largest of the financial markets that operate in the world. So there's an awful lot of information out there. There's an awful lot to try and digest, shall we say. So if you just want a little bit more information, want to have a chat, you've got something, you could have something on your mind and you're not sure about, then feel free to reach out. And we're always more than happy to help you out, even if it's just a case of explaining what something means or what the impact of the Conservative Party leadership could be, and so on. So always happy to pick up the phone.
Yeah, and I think the thing to say to anybody watching is that obviously we've put the links to Corpay there on the in the chat for anybody wanting to visit the website. But if anybody does want to speak to Tom directly, if they want to contact Residential Estates, and then we can pass the details on, and I'm sure Tom would be more than happy to hear from anybody. And we can pass those details on. So I think literally, and we'll also get something out to anybody that's registered on the webinar with Corpay's details and Tom's details. And again, like I say, just reply to that, and we will get details over to Tom. And I'm sure you'd be more than happy to assist.
Yeah, absolutely, yeah.
Fantastic. And we also, I mean, as you know as well, we also deal with a lot of agents in different countries as well. So we will be sending details over to those guys. So Tom, look, really appreciate your time this evening. I know you've had to sit there patiently, as we said before, while we rabbited on. But that was really useful information, certainly, like you said, for the overseas investors there. And like you said, anybody in the UK wanting to move money out as well. And you can help both sets of those. So anybody, like we say again, anybody wanting those details, just ping us a message and we will put you in touch. So again, thank you, Tom, for coming on this evening. That's been really helpful, and really appreciate your time.
No worries, guys. Thanks for having me.
Okay. And safe to say, everybody else, again, thank you very much for watching the webinar. We've gone through a lot. There's been a lot of information, and the slides will be available after the webinar to anybody. The replay will be sent. Anybody that's got any questions, feel free to get in contact with us via the website or any links that we will post in chat. Like I say, feel free to ask any questions as and when. Thank you very much to Abby, Rich, and Ian in the back end. And looking after things on that side of things. I know we've had a few issues in terms of internet connections and such like. I blame the weather.
Yeah, me too.
The weather and my age.
The weather and his age.
But again, just like I say again, thank you very much, Tom, for coming on. Thank you very much, everybody, for watching. Thank you very much, Johnsy.
Thank you very much. And I suppose it just says, and it's good night from me, and it's good night from him. Thanks, everybody, for joining.
Thanks all, and we'll see you on the next one.
Take care.
Bye-bye.